Welcome back. In this video, we're looking at an out-of-the-money butterfly, and what I've done is I've placed a $3 wide butterfly out here at an area around 268 that it's centered around, and that's where I've placed my net where I'm going to try and capture the price of the stock because I think the stock may be going higher. Or if I was going to use this as my trading strategy, I would use this when I do think that the market is going higher. So now with the lines that I have on the screen, I have my current price line over here at 262.73, and my two break-evens are shown here. And my probability number is 22.28%. And remember that in order to get this probability number to be valid on this Thinkorswim platform, you need to set the date 1 day past the expiration of your options, and then set the price slices to the two break-evens, the expiration break-evens, which would be where the blue line crosses this zero line here going across. So once you have that, then this number becomes a valid probability number to give you an idea of what's the chance that the trade will finish there by expiration. And notice that the probability is lower than we had when we were using the at-the-money options or the at-the-money butterfly. One other thing to note here is look at the cost of this butterfly. By buying the butterfly out of the money, we're only paying $42 for each butterfly spread. Now the drawback to that is we do need price to move. Price is right here, and on the at-the-money butterfly, if price didn't move or it went up a little and then came back to the same location, we could make some money on that trade because of the time decay that goes by on the income trades. In this case, we actually need price to move. We're putting this on as a directional trade where price has to move in the direction we choose. And then if it does move that, especially early in the trade, this could then become an income trade similar to the at-the-money butterfly once price has gotten into the zone where you're trying to capture the price at expiration. So this can be a low-cost trade to put on to try and grow your account, or it can be a hedge for some other positions where you pay a low cost and you need some extra protection to the upside, perhaps above some of your iron condor trades or some other trades that you have on. Before we move on though, I just wanted to show you the very narrow butterfly that you can get for very, very cheap. Now, you probably wouldn't get filled at 6 cents. You might have to sacrifice a couple pennies here to get a fill because of the bid-ask spread of the three different legs of the options that you're trying to get into, especially if the open interest is not that large up at these higher strikes. You may not be able to get in at the 6 cents, so you might have to sacrifice a couple pennies to get in. Either way, you're paying a very low cost to get into this trade, which could then make a substantial profit. But the problem is when I get to this trade, that 22.28 no longer counts. That was for the $3 wide. So let me come over here to price slices and right click on price slices. And I'm going to now left click and say set price slices to break even at the expiration. And when I do that, it now changes the two break even price slices to be the break evens of my current position that's on the screen. And notice that the $1 wide width between the strikes for this butterfly is only an 8% probability. So while you're paying a very small amount of money, your chances of it being successful out here are not very high, and you're also paying a substantial amount. If you're paying $1 a contract, you're paying $4 in commissions on an $8 trade. Some people say, well, this is only $8 per spread. Why don't I just do 10 of them? And while that sounds great, if you're paying $1 per contract, you're paying $40 in commissions to put the trade on, and you're paying $80 to get in the trade. And more often than not, more than 9 times out of 10, this trade is going to lose money for you. Unless you had some really good reason for putting this on this narrow with this low of a probability, while you could make a substantial amount of money if at expiration price finished inside this net. Most of the time, it's not an advisable trade to use, as tempting as it may seem. So in the next video, before we get to the high probability butterfly examples that I want to show you, which is the purpose of this course, I just want to show you one more thing about butterflies, comparing a call butterfly, a put butterfly, and an iron butterfly, just so you can see what they look like.